We've got Shake Shack down 9% after reporting mixed results for the quarter. Joining us now from MKM Partners, Brett Levy has a hold rating on the stock. Brett, it looks like the guidance came in a little bit weaker on revenues. The company said January was weak on traffic because of Omicron, but they're seeing February same Shack sales up 13% month to date. Talk about the numbers and versus the expectations, and how do you make sense of the reaction?
Great. Thanks for having me on first. What we have here is similar to what we've seen across the industry so far, and that's been as we exited December and it went into January, Omicron had a materially negative impact on transactions and traffic across the industry and sales. So what we saw out of Shake Shack isn't dissimilar for what we've seen across the industry. The bounce back is also something that we've seen so far into February. The magnitude of the miss in January coupled with the performance in February leads to a challenging result for the rest of the quarter as they're starting to go against the reopening and the stimulus from last year. So as a result, missing on the top line, lowering, coming in below what the expectations were on the same Shack results, coupled with the pressures that they're seeing at the margin, all of those factors go into weigh on the negativity in the near term.
How should we think about how they are equipped to deal with a comeback of sorts? I mean, as Sarah had mentioned, everything was improving in February. And if we do get to better levels because Omicron has passed and there are more reopening measures, et cetera, how should we think about, for instance, wage pressures and labor shortages?
There's two dynamics at play for Shake Shack. First, there's the long-term algorithm that they put into play. And this is a company that, unlike many traditional consumer and retail-based companies, that views themselves for the long term, making these outsized investments in technology, a willingness to test on new formats for their store design, including their first drive-throughs late last year. So what they're trying to do is get closer to the consumer with technology, with drive-throughs, while staying true to the core business, which is the consumer experience. What you've seen there is a willingness to go out and hire, raise wages, treat their employees well, offer competitive benefits. So that way, when the consumers come back, they won't come back to a bare bones operation. They'll come back to the experience that they like, but they'll also come back to one that's morphed into the next generation of implementing technology and convenience, things that differentiated others from them, but something that they're starting to bridge the gap with.
Stock is falling even harder after hours, down 10.2%. Brett, thank you for the quick take. Brett Levy.